Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
Okay, so $1.17. That is the number on the screen this morning pre-market, Wednesday, February 18th, 2026. We are looking at Banzai International, ticker BNZI.
And that number tells a pretty violent story about yesterday, doesn't it? We saw a 7.69% drop in the Tuesday session. Stock closed at 119, and now we are ticking lower.
It's volatile, no question. But, you have to look at the context of that volatility. Just last week, February 9th, we saw volume spike to over 2 million shares. For a stock that averages, around 800,000? That is massive. That's institutional interest. We saw it pop nearly 16% that day, hit 140. The market is trying to figure this thing out.
Or the market figured it out. And that's why it gave back every single cent of those gains immediately. You call it institutional interest, I call it a liquidity event for trapped holders to finally get out. And, well, that brings us to the core issue here, right? Is Banzai International a distressed asset that has been, hollowed out to the point where it's a coiled spring just ready for a huge AI-driven turnaround?
That is exactly my thesis. At a $15.5 million market cap, this thing is priced for death, but the vital signs are actually improving.
Or is it a classic liquidity trap? I am looking at a company that is defined by toxic dilution, structural overhangs that just act like a ceiling on the price, and a balance sheet that is, for all intents and purposes, on life support.
I want to tackle that head on because I know the chart looks ugly. I get it. But I am arguing that the market is looking in the rearview mirror. They are pricing in the past failures, the legacy debt, the old business model. The smart money, and I'm talking about the institutional creditors, who are now the biggest equity holders, are pricing it for a recovery targeting $23.
And I am arguing that when you have 1,356% dilution in a single year, and I just want listeners to really process that number, 1,300%. A $23 target isn't an investment thesis. It's a hallucination. This isn't about the technology anymore. It's about financial engineering.
Well, let's start with the business itself then, because you can't value the stock if you don't understand the pivot. 2 years ago, sure, Banzai was a struggling marketing tech firm. Today, it is an AI-first marketing suite. They focus on 3 pillars: acquisition, engagement, and analytics. But the real catalyst, the thing that changes the math completely, is the Superblocks acquisition from November 10th, 2025.
You call it a catalyst. I see it as a desperate bolt-on to distract from the core cash burn.
It is the secret sauce. Superblocks is an AI web development and hosting platform. It lets marketing teams build data-driven assets instantly. But forget the buzzwords for a second and just look at the pro forma financials. Superblocks adds $6.5 million in revenue and, more importantly, $2.3 million in EBITDA.
EBITDA, right. Earnings before interest, taxes, depreciation, and amortization. Basically a proxy for operational cash flow.
Exactly. And for Banzai, which had a trailing 12-month EBITDA loss of over $17 million, injecting a business unit that generates a positive $2.3 million, well, it's a game changer. It stops the bleeding. And they have 4,590 existing customers. If they cross-sell Superblocks to just a fraction of that base, the revenue doesn't just grow, it compounds. Analysts are projecting 2026 sales to hit $16.88 million. You are buying this company today for less than 1x forward sales. In the software world, that is absurdly cheap.
I'm sorry, but I don't buy that valuation argument. You're doing the revenue multiple dance. It's a classic trap. You say, look how cheap it is compared to sales. But stocks don't trade on sales revenue alone. They trade on the supply and demand of shares. And the supply side here is, well, it's horrific. You mentioned the market cap is 15.5 million, but let's talk about the share count. That 1,356% increase in shares outstanding over the last year, that is financial violence.
It was a necessary restructuring to keep the lights on and clear out the legacy debt.
It was a wipeout for anywhere who held the stock. And let's not forget the 1-for-10 reverse split back in July 2025. That was supposed to be the fix, right? It was supposed to defend the $1 compliance level. And here we are, February 2026, drifting right back toward $1. The reverse split didn't fix the company, it just reset the counter so they could sell more stock.
But that is the past. You are focused on the dilution that has already happened. I am focused on the asset that remains.
I am focused on the dilution that is about to happen. That is the problem. On January 16, 2026, they filed a standby equity purchase agreement, a SEPA, with Yorkville Advisors.
Which provides necessary liquidity. It is a backstop.
It is an overhang. Let's explain what this actually means. They registered 25 million shares for resale. Now, currently, there are only about 11.69 million shares outstanding. Think about that math. Yorkville has the ability to dump more than double the entire current float into the market. Every time the stock tries to rally, like that pop on February 9th, Yorkville can just step in, sell shares, and crush the momentum. It creates a ceiling.
That is a compelling argument regarding the technicals, I admit. The SEPA is heavy. But I would frame the ownership structure very differently. You see a company being sold off by financiers. I see a company being restructured by sophisticated credit investors who are swapping debt for equity because they want to own the upside.
You're talking about the lenders?
Yes, CPBF Lending, led by Brad Shane of Columbia Pacific Advisors and Alco Investment Company. Together, these creditors hold over 35% of the equity. Columbia Pacific owns about 18.7% and Alco owns 17.8%. Now, Columbia Pacific isn't some retail trader gambling on a meme stock. They are a registered investment advisor specializing in distressed assets. In October 2025, they eliminated $4.8 million in senior debt by swapping it for equity.
Right, they swapped it because the company couldn't pay them the cash.
Or they swapped it because they see more value in the equity than they do in the debt. If they thought this was going to zero, they would be liquidating assets, seizing the IP, selling off the furniture. They aren't doing that. They are taking a massive equity stake. They are effectively taking control of the company to steer the turnaround. When the creditors become the largest shareholders, the bankruptcy risk drops significantly because, they aren't going to foreclose on themselves.
See, I come at it from a different way. I see this as loan-to-own behavior, but not in a benevolent way. These firms are professionals at extracting value. You mentioned they are swapping debt, but look at the new financing. Just a few days ago, February 13th, 2026, they issued a $2.33 million convertible note.
Which provides working capital. They netted $1.6 million to fund the Superbox integration.
But look at the cost. It has a 10% original issue discount and a 10% interest rate. And this is the critical part. It is convertible at $1.11 per share. That is the floor. When a company has to pay that much for a couple of $1 million, it tells you their cost of capital is incredibly high. It screams desperation. The interest coverage ratio is negative 3.64. They literally cannot pay the interest on their debt from operations, so they have to issue more equity or more expensive debt. It is a death spiral. Columbia Pacific might end up owning the whole company, sure, but the retail shareholder buying at $117 is going to get diluted into oblivion while that happens.
I think you are too focused on the balance sheet mechanics and you're missing the operational pivot that is happening right now. You can't fix a balance sheet without fixing the business, and they are doing that.
Are they, though?
Yes, look at the leadership. They realized the old growth at all costs strategy wasn't working. So in mid-2025, they brought in Michael Kurtzman as CRO and Matt McCurdy as VP of Sales. These are guys hired specifically to fix the funnel and drive that AI marketing solution. They are moving away from the moonshots.
The moonshots like the Acton merger, we have to remind people of that. June 2025, they announced a $53 million merger with Acton. The stock rallied. Everyone got excited. And then it completely collapsed because they couldn't find the funding. That is execution risk. That is management saying they are going to do something big and then failing because the market doesn't trust them with capital.
And that failure forced the discipline they have now. They pivoted to smaller, digestible acquisitions like Superblocks. And the board is showing confidence. Look at the insider activity from earlier this month. On February 6, 2026, the directors, Mason Ward, Paula Boggs, Kent Schofield, they all accepted restricted stock units, RSUs, instead of cash.
To conserve cash.
And to align with shareholders. Ward took 61,500 RSUs. Boggs took over 55,000. These vest in 2027. They are betting that the stock will be worth something in a year.
If they thought the company was going under, they would have demanded cash fees or just resigned.
Or they know there is no cash to pay them, so they take the lottery ticket. And while the directors are taking stock, the CEO, Joseph Davy, was selling. He sold about 51,000 shares in late 2025. He still owns 2.3 million shares. I mean, that sale was less than 2% of his holdings.
It's still selling. He isn't buying. And you can't ignore the going concern warning in the filings. Management themselves are saying there is substantial doubt about their ability to survive. That's not me being a bear. That is the company telling you the risk in black and white.
Every turnaround starts with a going concern warning. That's why the opportunity exists. If everything was perfect, the stock would be at $10, not $117. So let's talk about that price, because I think the valuation has completely disconnected from reality.
We tried to break it on February 12th and failed. We tried on the 13th and failed. The moving averages, both short-term and long-term, are screaming sell. The NASDAQ listing risk is real. They need to stay above $1.
But they are about $1.
Barely. They are at 117. One bad week, one more dump from the Yorkville SEPA, and they are below $1 again. If they lose the NASDAQ listing and go to OTC, the institutional support just vanishes. And they also need to maintain $2.5 million in stockholders' equity. With the losses they are running, that is a constant struggle.
But that's exactly why the creditors, Columbia Pacific and Alco, are so involved. They aren't going to let this go to OTC. They have too much capital tied up in it. They will engineer the balance sheet to keep it compliant. That's the safety net. But I want to go back to the upside case because you are ignoring the analyst coverage. Ascendiant Capital has a price target of $23.
They lowered it from $30.
But it's still $23. The stock is at $1.17. That is a 20x return if they are right. The consensus rating is a strong buy. Why? Because analysts are looking at the 2026 estimates. They see EPS improving by 95% in 2025. They see the Superblocks revenue kicking in. If Banzai hits the Q4 earnings estimates on April 14th and shows that 6.5 million revenue bump from Superblocks, the narrative changes overnight. The stock re-rates from distressed asset to growth.
That is a massive if. You are relying on a re-rate to save you from a delisting. And speaking of the sector, marketing tech is brutal right now. You have activists swarming, you have consolidation. Banzai is a minnow in a tank of sharks. If they stumble on the Superblocks integration, if that secret sauce doesn't taste right to the customers, there is no buffer left.
I disagree. The volatility in the sector is actually a tailwind. AI is disrupting everything. Legacy players are stuck with old tech stacks. Banzai has positioned itself correctly with the AI-first pivot. They aren't trying to be a legacy email sender anymore. They're an analytics and engagement platform. The market is paying a premium for AI, and right now, Banzai is trading at a discount for distress. That gap is the opportunity.
The AI label is being slapped on everything. Acquiring Superblocks doesn't make you an AI leader overnight. It makes you a holding company with a new toy. The core business was losing money. The interest payments are eating them alive. You mentioned the cross-selling opportunity to the, 4,500 customers. But these customers have seen Banzai's struggle. They saw the failed merger. Are they really going to increase their spend with a vendor that has a going concern warning?
Customers care about the product, not the stock price or the SEC filings. If Superblocks helps them build marketing assets faster and cheaper, they will buy it. And Michael Kurtman's job is to make sure they buy it. The fact that sales are projected to grow to 16.88 million suggests that the demand is there.
Projections are easy. Execution is hard, especially when you have no cash. $851,000 in cash against $14.48 million in debt. That was the position in late 2025. Even with the new $2.33 million note, the runway is incredibly short. They are burning furniture to keep the house warm.
They're investing in the pivot. And frankly, the debt reduction, $32.7 million, eliminated through August 2025, shows they can manage the balance sheet. They cut interest expenses significantly. That flows straight to the bottom line. Net income is expected to improve by $13.5 million annually just from those moves.
Improving from a disaster to a manageable disaster just isn't enough for me to invest. I see a company that exists to sell shares, not software. The Yorkville deal is the smoking gun. 25 million shares. That is the only number that matters. Until that overhang is cleared, any rally is just a selling opportunity for the financiers.
I see why you think that, but let me give you a different perspective on the overhang. If the turnaround works, if they hit that 16 million revenue number, the volume will absorb that overhang. We saw 2 million shares trade on February 9th. The liquidity is there when the news is good. If they deliver on April 14th, that SEPA overhang becomes a stepping stone, not a wall.
Or it becomes the avalanche that buries the retail investor.
So let's try to summarize where we stand. I look at Banzai International and I see a classic hollowed out opportunity. The market has priced in the bankruptcy, the dilution, and the debt. It is sitting at a $15.5 million market cap. But underneath that, you have a company that has shed its bad debt, pivoted to AI with superblocks, and is backed by powerful, sophisticated creditors like Columbia Pacific, who are effectively owners now. The risk is high, yes, but the reward, if they hit that $23 analyst target, is massive.
And I look at the same data and see a structure that is fundamentally toxic for the common shareholder. The 1,300% dilution was just the first wave. The 25 million share SEPA overhang ensures that for every buyer, there is a motivated seller waiting to unload. The company cannot pay its debt from operations, forcing it into expensive, predatory financing like the recent 10% convertible note. Until they can prove they are a business and not just a vehicle for selling discounted equity, this is a gamble. It's not an investment.
We can agree on one thing, though. The next major catalyst is clearly defined.
Yes. April 14th, 2026. Q4 earnings.
That is the moment of truth. We need to see if the superblocks revenue actually shows up in the numbers.
And we need to see if they burn through all that new cash already.
The debate really rests on whether the secret sauce of the AI product can outrun the dilution engine.
I'm betting on the dilution engine.
And I'm betting on the turnaround.
That's what makes a market.
Indeed. Thank you for listening to The Debate.
Until next time.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.